fear of a stock market crash is always present. Every investor lives with the risk of a major economic meltdown. It's happened before and it can happen again. If it does, it could wipe out years of hard-earned savings and retirement funds in hours. According to recent results from the E-Trade survey, an increasing majority of investors believe the stock market is in a bubble. 69% of 957 active investors who manage at least $10,000 in an online brokerage account think the market is either fully or somewhat in a bubble. On top of that, 22% of investors stated stock valuations are approaching a market bubble, while hardly 9% responded valuations are not close to a market bubble. However, the answer to whether the stock market is currently in a bubble is unclear across Wall Street. Goldman Sachs' chief global equity strategist recently researched 300 years of market history and concluded that although many bubble characteristics are present today, stocks are not in a full-fledged bubble. But what does Howard Marks think about that? The co-founder of Oak Tree Capital Management was born in New York and began his career at Citibank. In 1985, he joined TCW Group as an asset manager, and in 1995, he co-founded Oak Tree Capital Management with the strategy of investing in private equity, high-yield debt, and distressed debt. During the financial crisis to buy distressed assets, his hedge fund has raised $10 billion, which paid off well for Oak Tree investors. In 2019, Oak Tree sold 61% of its stake to Brookfield Asset Management for $4.9 billion in cash and stock. Despite that, Oak Tree is operating independently, and Marks is leading all the activities. He's a distressed debt investor, and he firmly believes in pursuing investment possibilities that others are overlooking. Although Marks says we're not yet in a bubble, he cautioned savvy investors that there are reasons to take less risk. So, he believes investors should take some risk off the table, given some of the challenges the market faces. According to him, the economic expansion and the bull market are old. He said valuations are above average, and there's a lot of uncertainty in the world, so it strikes him that one should not have as much risk as one did 3 or 6 years ago. He said they have what he calls a fear of missing out, or FOMO, and that's taken over from the fear of losing money because people have to be invested in this world when things are going up. All these things are somewhat problematic, and of course, the PE ratio on the S&P is high relative to history. He claims the biggest challenge that investors will face is from deciding how to get a decent return in a low-return world without taking an inordinate risk. At the very end of last year, Marks cautioned investors that the current circumstances may pave the way for the lowest prospective returns in history, and that investors should anticipate lower returns to move forward. He also added that the market could be vulnerable to negative surprises amid uncertainties related to the current global health situation. Given the wide range of potential outcomes with this situation, the magnitude of risk taken on by investors is undoubtedly tricky to comprehend, even given the US Fed's commitment to preventing an economic depression for which the likes we haven't seen in almost 100 years. Although, in theory, higher potential risks should come with greater returns. But after the latest market run-up, many pundits don't seem to think that the prospective returns from these levels make up for the profound magnitude of risks looking forward. Since no one is sure when we will be getting out from this global problem we're currently in, it's not a mystery why Marks thinks the market setup isn't looking too good for those looking for significant gains over the coming years. When asked how he would start and end a memo called World According to Me in 2023, Marks replied it would begin and end with a statement that he does not actually believe in predictions. What he means is that we never know where we were going, but we sure ought to know where we are. That is why the book's essence is to predict your investment decision to understand where we stand in the cycle today. It is possible to know where we stand in the process today. It is not possible to understand what is going to happen tomorrow. According to him, where we stand in the cycle determines the probability distribution of returns that investors would face. They should know what the probability distribution would look like when it's in their favor and when it's against them. That is the most significant theme of the book. Although he cannot and will not try to predict a market crash when the market does fall, Marks said you should not immediately expect a crash either. Modern investors might expect significant oscillations in the market since their experience of major downturns had been the dot-com bust and subprime mortgage crisis, but they should look even further back in history. He stated that we had lots of minor boomlets over the previous decade and then corrections, so we should not automatically think of the bubble crash. Marks said the symbol of a bubble is the presence of bubble thinking, where investors take a grain of truth and run away with the concept. In the late 1990s, the grain of truth was that the internet would change the world. Although it did change the world, about 9 out of 10 companies in the sector also ended up valueless. This bubble thinking surfaces periodically in history. Continuing his story about bubble thinking, Marx remembered the time when he took a summer job in Citibank's investment research department in 1968. During this period, investors were crazy for the Nifty 50. The Nifty 50 represented 50 large-cap, blue-chip growth stocks in the USA, including IBM, Xerox, and Coca-Cola. He stated that they were selling for astronomical prices of 80 to 90 times earnings. That compares with the average price-to-earnings ratio for the S&P 500 in the post-war period of about 16 times payments. However, it turned out that investors who bought these stocks and then held them for 5 years would have lost 97% of their investment. Because of this, Marx concludes that price does matter. According to Howard Marks himself, two questions he's often asked are we in a bubble, and are we going to have another crash? He states that this is understandable because those who came into the market as much as 25 years ago have seen 2 bubbles and 2 crashes. However, he also claims that markets aren't always about extreme ups and downs. There are bull markets and bear markets, rises and corrections. With that said, he adds he doesn't believe that we're in a bubble and does not think we're going to have a crash. While other famous investors like Jeremy Grantham are calling for the top of the market, Marx said that the market's future trajectory is less clear. He concluded that there's increasing mention of a possible bubble based on concerns about valuations, federal government spending, inflation, and interest rates. Still, he sees too many positives for the answer to be black or white. One thing that could spark another market crash is negative surprises. Although Howard Marks is a genius investor, not he nor Warren Buffett knows with certainty where the markets are headed next. Sure, things could be brighter than Marks believes, but with the current situation, it's tough to go all in on stocks based on optimism, the Fed's backing, and other stimulus packages. There's also Marx's warning that the markets could have a higher chance of being hit with negative surprises. If things take a turn for the worse in the future, there's no question that the stock market could be in for another round of panic-driven selling that could rival the market crash suffered back in last February and March. Given the uncertain outlook currently facing the economy, forecasting the stock market's performance is likely to be even more challenging. Therefore, following Mark's advice to buy attractive stocks for the long run and largely ignore short-term price movements could be a good idea. Attempting to foretell the stock market's future performance may not be a productive use of your time, though its future may include events that are similar to those it's encountered in the past. Throughout history, the stock market has operated in cycles. The catalysts for its bull markets and bear markets may be unique when they occur, but the stock market's track record of recovering from its lows to produce new highs is likely to continue in the long run. Marx advises investors to use history to decide on potential performance of the index over the long run. In his latest memo, Howard Marks rejected the notion that the stock market is currently in a bubble and said that most asset prices are still justifiable. However, he admits the temperature of the market is elevated and says there are signs of euphoria and risky behavior as investors pile into so-called meme stocks and broaden into riskier assets in a desperate grasp for returns. Nevertheless, he concludes a bubble connotes unreasonably optimistic psychology and a belief that there's no price too high for the bubble asset. I don't think that those are going on today. I just think that all prices are up because of all the demand, as well as returns being down. Be sure to comment down below and let us know if we've missed something. Hit that subscribe button and turn on the bell to never miss an upload. Thank you very much for watching.